So now moving to the changes in other laws, we proceed for the next session on amendments in corporate law. We are privileged to welcome our visiting speaker, Vinod Kothari, Managing Partner at Vinod Kothari and Company. Mr. Kothari is extreme authority in company law with over 35 years of experience, a fellow member of ICAI and ICSI. He has contributed as specialist editor to Ramaya's company law and authored several influential work, including Understanding Companies Act 2013 and Guide to Independence Director. His publications span corporate governance and securitization, and he regularly advises leading companies on complex legal tax matters. A sought-after speaker on related party transaction and CSR, Mr. Kothari has delivered lectures in the USA, UK, Italy, Germany, UAE, and India. Welcome, sir. How are you?
I'm perfectly good. How about yourself?
I'm really good, sir. Thank you.
So that's nice to hear because it's been a marathon session. And as in case of every marathon, what matters is people who last the longest. Not necessarily people who run very fast, but people who last till the end. So Divya, you have been lasting throughout the day with
Thank
the
you, sir.
blast of speakers one after the other. And you still seem to be absolutely fresh and of course energized. So that's very commendable.
Thank you, sir. Thank you so much. The stage is all yours now.
Thanks, done. So do I start straight away?
Yes, sir.
Excellent. So welcome to all the participants who have been part of this marathon session for the day today. And it's indeed nice to see that several of you are still staying back through this extremely long day, full of deliberations by various speakers. And what I'm going to do over the next half an hour or so is to give a view of the amendments, the changes which would affect the corporate sector, the financial markets, and may lead to a long-term change in the country's economy over time. Now, before I begin, I must just give a quick view of what's the state of the economy in general. And as I'm sure everyone would agree that we are facing global headwinds because of the geopolitical tensions in certain parts of the world, but more significantly, more recently, the economic policies of some leading countries in the world. And therefore, the times to come may not be quite smooth for the economy because to an extent there might be disruptions. Well, every challenge brings an opportunity as well. And we are happy to have a leadership which is able to capture challenges and convert them into opportunities. So let's be optimistic on that front. But generally speaking, when it comes to financial markets and the corporate sector in general, the growth rate this year for the part of the year has been lower than expected, particularly from the manufacturing sector. And that apart, in the financial sector too, the default rates seem to be going up, at least in context of personal loans and microfinance loans. And as I'm sure everyone would be aware that recently the banking sector had increased its penetration towards the personal loan segment. The proportion of personal loans has been increasing on bankers' books, and default rates continue to increase in the personal loan come or personal loan or microfinance segment. It would present a challenge before the banking sector. So we are all braced up for the challenging times to come. In the past, the country has faced several such challenging occasions. The country has come up quite well through these challenging periods as well. And I'm sure even now the country would be able to cope up with the challenges posed by the new environment. Now, in terms of the changes proposed in the budget, now budget typically does not tinker with corporate laws. It normally tinkers with Income Tax Act. And this time, even when it comes to Income Tax Act, there are some segmental changes here and there, but the finance minister clearly says that she will be presenting a new income tax bill in this very session of the parliament. So maybe in the coming week, maybe this remaining part of the week, or maybe in the coming week, we might be seeing the introduction of finance bill. And that would be a lot of fodder for discussion in time to come. But let's maybe leave that aside and talk about what is the finance minister proposing for the corporate sector, financial markets, and capital markets in general. Last year's budget, though it was for the part of the financial year, which presents several interesting proposals relating to providing credit support to MSMEs and so on. Now, automatic question that comes is that these announcements were made as part of the budget, but what happens to them? What is the state of implementation of the proposals or the announcements made in last year's budget? Every year's budget, I'm sure people may not be seeing it so very carefully, but there is also a statement on implementation status of last year's proposals. And if you go through the implementation status of the proposals made in budget 2024, in most of the significant proposals, you would find cabinet note under preparation, cabinet note being finalized, or the meetings being held, and so on, which essentially would mean that for many of the proposals contained in the last year's budget, action has still not been taken. The action still seems to be work in progress. Now, that is a little disappointing because from this particular government, at least what the nation expects is that it means action. It's not someone who would merely talk but walk the talk. This is the government which is supposed to be walking the talk and not merely talking. Now, if we get continued budget announcements which are still stuck somewhere in the process of bureaucratic decision making, then we are in a situation of what is called policy paralysis, and that is definitely not healthy for the country. So in many respects, action is still expected. That's a very important point, because as we talk about what are the proposals in this budget as well, many of them will require action, many of them will require concrete action. For example, something called partial credit guarantee. I'm going to talk about this as I speak now. It's been in the works for nearly 3 years now. Similarly, for development of securitization market in the country, it's something which is in the works for last more than 3 years. So these are things which are continuing for quite some time, but action on these is still not yet to the expected levels. So I'll be today talking about the following proposals, some of which probably might be overlapping with what other speakers might have discussed. Perspectives might be different, therefore please bear me out. I will not be exactly saying the same thing which other speakers might have said. Number one, I'll talk about the proposal for increasing foreign direct investment in insurance sector. What does it mean? What are the conditionalities? What impact does it have for the country? Number two, I'll talk about partial credit guarantee scheme, whereby a specialized All India financial institution called National Bank for Financing Infrastructure Development, NABFID as it's very commonly called, NABFID will provide partial credit guarantee for bonds issued by infrastructure entities. What does this PCG scheme actually imply? What are the challenges towards giving up such guarantees? What impact might it have for the infrastructure sector of the country? And once again, while I talk about this, it's very important that last year's budget, one of the highlight points of last year's budget was, if people recollect, there was a number called 111111, many ones, 11 lakh, 11,000, 1100, 11 crores of rupees was the outlay for infrastructure sector. Once again, I'm repeating, there were several ones, and the finance minister made it it was received with thumping noise in the parliament. 11 lakhs, 11,000, 1111 was the outlay for the infrastructure sector in the last budget. Of that outlay of 11 lakhs odd, how much has actually been spent? If you look at the actual spending number, the actual spending number is actually down by more than a lakh crore rupees. In a sense, therefore, infrastructure, which is the most important component of the country's economy, I mean, that's something which doesn't require much of elaboration, because this country's economic engine is all dependent on the spending that we do in infrastructure sector, and therefore active energizing infrastructure entities facilitating their access to capital markets, facilitating their access to funding remains extremely critical for the country. Therefore, this point number two that I'm going to talk about today, partial credit guarantee for um, for infrastructure entities by NABFID, that becomes a very important point to discuss. Number three is, I'm sure, something that might have been talked about by earlier speakers, but I'll have some perspective to share on that, which is the end to the evergreening of losses in a case of amalgamation. This is something which, I mean, from a point of view of corporate restructuring, always remains interesting. We will be talking about that. In addition, I'll also talk about, there's a mention in Finance Minister's speech about facilitating fast track mergers. What does it actually imply and what implications might it have? I'd like to talk about that. Uh, it's an important part of the country's promise to international investors to popularize the International Financial Services Center (IFSC), also quite often called Gift City. And there are several proposals to further attract investments in IFSC. And therefore, there are some proposals that I'd like to talk about. Number one, in case of leasing transactions out of IFSC, part one. And part two, there is something called Treasury Center activities out of IFSC. I'll maybe briefly talk about that as well. There are some other changes about fund management entities out of IFSC, but that's something that, as I can see from the agenda, there are other speakers who might have talked about that. So I will therefore not take your time on that. And then there is a change on crypto assets. There's a widening of definition of crypto assets, virtual digital assets. I'll briefly like to talk about that as well. And finally, regulatory reforms. Now, this is most important. I would say this is one of the most important topics to discuss, because if any of you might have gone through the economic survey this year, the theme of the economic survey was very clearly deregulation. It very clearly dwelt on the theme of deregulation, because this country's economy currently where we stand, it's very important to let the government get out of the way of business to the extent the government can. That is without compromising on social justice, without compromising on equity, without compromising on basic safeguards which any government has to take. The economic survey very clearly throws a signal that the government has to get out of the way of the business. Get out of the way, meaning let the business run its own course. You can lay basic guardrails, you can lay basic rules of conduct, but don't continue to regulate business in every micro aspect, which is what is seemingly happening today, because, as I'm sure everyone agrees, compliance burden for businesses has tremendously increased. Not only are compliances getting more and more granular, the cost of non-compliance has gone up multifold. While we talk and talk a lot about decriminalization, but decriminalization is, that's the monetary aspect that you'll probably not be put to punishment. You'll probably have to pay penalty and get out of the matter. But the issue is that the penalties itself have become quite large, quite huge. Number two, it's not all about paying a penalty. It's the consequence of having been punished under a law. Because today, if you have faced a penal consequence under any law, subsequently, as you go for any subsequent business proposition, and you are asked to explain, have you been punished under provisions of XYZ laws? If the answer becomes yes, it becomes a crime mark. It becomes a sort of bad spot on the career of either an individual or a company for years to come. So that's very important to ensure that we have reduced compliance burden. Business becomes competitive. Business is allowed to continue without micro intervention of the policymaker. That's a very important point on which, well, the government needs to take tangible action. Let's see that the action is taken and taken soon enough. So that's a very important proposal, to have a high-level committee for regulatory reforms. I'll talk about that as well. Let me first start by the first proposal, which is foreign direct investment in the insurance sector. Now, here, what's the proposal? The proposal is, as of now, the country permits up to 74% foreign direct investment in insurance sector. Insurance sector, I'm sure everyone realizes, is a very significant sector for the country's economy. Insurance, unlike rest of the financial services sector, financial services, for example, let's say uh, non-banking finance companies, how much FDI is allowed? 100%. In the banking sector, of course, FDI allowed is up to a limit, but when it comes to non-banking financial services, 100% FDI is allowed. But when it comes to insurance, once again, the country has taken a very careful route of not permitting FDI to the extent of 100%. So till 2021, the permitted level of FDI in insurance sector was only 49%. 49% only was permitted. And if, in other words, the maximum cap, what is called sectoral cap on foreign direct investment in the country for insurance sector was so far, until 2021 was 49. This 49 was extended to 74% in 2021. So as of now, we have up to 74% cap on FDI in the insurance sector. What's the country now proposing? Now we're proposing to increase the cap, remove the sectoral cap and take it to 100%. That doesn't mean the sectoral cap becomes irrelevant. We will still have some conditionalities, but now up to 100% investment by way of foreign direct investment in insurance companies would be permitted. So let's first of all realize that does that mean the insurance companies can now be completely owned by non-resident shareholders? Answer seems yes. In addition, can there be a foreign portfolio investor participation as well? To that also answer is yes. When it comes to sectoral cap of FDI, not only are we including what is called direct foreign investment, we are also including foreign portfolio investment. Even the investment made by foreign portfolio investors, FPIs as we call them, even that is captured as a foreign direct investment for the purpose of sectoral limit. So when we talk about 74% limit as existing now, it includes foreign direct investment, that is direct holding of capital by non-residents, as also portfolio investments made by foreign portfolio investors. So now the proposal, therefore, the budget says the default percentage would still be 74%. The investment is permitted subject to conditionalities. I'll talk about what the conditionalities are. At the same time, the finance minister also says that the conditionalities and guardrails will be reviewed and simplified. What will this review or simplification be? We don't know as of now, but I'll talk about what are the guardrails and what are the conditionalities as existing as of now. Now, the extent of investment, foreign investment in insurance companies is governed by two sets of rules. Number one, the normal what you call FDI policy, non-debt instruments, investment in NDI instruments, rules pertaining to investment in non-debt instruments, which is actually equity instruments. That's part one. Part two, there's another set of rules called Indian Insurance Companies Foreign Investment Rules. You can see these are the rules we mentioned in the Indian Insurance Companies Foreign Investment Rules 2015. These rules also lead, number one, the limits, and number two, they lead the conditionalities. Also, to an extent, the provisions of the Insurance Act also become relevant because the Insurance Act also contains certain conditions about foreign investments. So, first of all, Section 27E of the Insurance Act prohibits insurance companies from investing the funds of the policyholders outside India. It says whatever funds an insurance company garners from policyholders, it has to be invested 100% within the country. And Section 27C allows an insurance to invest not more than 5% in aggregate of its controlled funds or assets in companies belonging to promoters subject to conditionalities. So the condition of investing back the proceeds of policies is a part of the statute. Are we meaning to relax this condition? I would actually think no. In other words, the existing conditionality of investing back the proceeds of the policy within the country being a part of the statute, quite likely the conditionality will remain. It will not be tinkered. Now, what about the other conditionalities? The other conditionalities which are laid in the investments in insurance companies Foreign Investment Rules 2015, the conditionalities relate to primarily corporate governance. And these conditions say that number one, the majority of the directors in the insurance companies must be Indian citizens, not just Indian residents, Indian citizens. Majority of the directors must be Indian citizens, number one. Number two, it says majority of the KMPs must also be Indian citizens. Key managerial personnel must also be Indian citizens. At least one among the chairman, managing director, or CEO must also be Indian citizen. At least half of the directors should be independent directors. And any FDI in insurance sector is allowed subject to verification by IRDA. In other words, even as the investment limit is extended from 74% to 100%, the investment proposals into any insurance company would still be subject to IRDA verification. What does IRDA verification actually do? IRDA goes into the source of funds. As I'm sure you understand that one of the concerns right now the country has is investment from countries whose land borders are shared with the country. I hope you understand which country I'm talking about. So IRDA very carefully examines the source of the money, essentially to ensure itself that there is no concern about where is the money coming from. So IRDA will do its own DD on the investors. And it's only after the DD is done by RDA, the RDA is satisfied about the sources of funds, that increased investment in insurance companies will be permitted. Now, in context of this proposal, what does it actually mean for the country as a whole? First of all, let's understand that penetration of insurance in India. Penetration actually means what? Proportion of insurance premiums to the country GDP. That's taken as penetration. That is insurance premiums divided by the country GDP penetration ratio that actually declined in financial year 2024 from 4% to 3.7%. And this decline was largely attributable to decline in penetration of life insurance. Non-life almost remained constant, but life penetration came down. When life penetration comes down, what does it mean? That actually means the growth of insurance premium was not matched by the growth of GDP. In other words, GDP growth was faster than the growth of insurance premium, and thereby the penetration ratio marginally fell down. Now, if you compare this penetration ratio with the rest of the world, global average is upwards of 7%. That would mean where we are in the country today, we are at 4%, less than 4%. Globally, it ought to be at 7. So there's a long distance for India to travel still. In other words, there's a substantial scope for insurance business to grow in the country to come to par with how rest of the countries in the world are. And there is also a projection that the insurance sector in India I'm sorry about that. The insurance sector in India is expected to grow at 11% CAGR. CAGR means cumulative average growth rate, compound average growth rate. It's supposed to be growing at 11%, and India is expected to become the largest insurance market in next 6 years. This is a very important point to note. India is expected to become the largest insurance market by next 6 years. Now, at 11% growth rate is extremely, I would say, attractive growth rate, and India becoming the largest insurance market, which actually means what? There has to be substantial scope in the substantial expansion in insurance business in the country. So, in the past, the extent of foreign direct investment in insurance sector has not been extremely impressive. That's very important point to note that though in 2021, we increased the limit of FDI from 49% to 74%. Were there a lot of takers? In fact, from 2014 up to 2023, for a period of 10 years, the aggregate amount of foreign direct investment in insurance sector is only roughly about 54,000 crores, which means it's not been a very great segment for attracting foreign investment. But looking at the prospects of 11% CAGR, one hopes that there might be a significant uh, interest, there might be significant traction among foreign investors to invest in insurance sector. So what is the likely impact of this proposal? Number one, it reinforces India as an FDI destination. Now, once again, India as a foreign direct investment destination. Are we doing great? I would once again say no, because in FY 24-25, the net foreign inflows in the country by way of FDI were roughly about 20 lakh crores. And sorry, 28 billion US dollars, 28 billion US dollars. And if you compare this with the number in the last peak year was 2020, in that year, the net foreign inflow was $64 billion. In other words, if you compare with FY20, that is 1920 pre-COVID period, we had a net FDI inflow of 64 billion US dollars, whereas in FY24 we only had $28 billion, which means a substantially lower FDI in the country. Now, if you were to anyway compare that with China, we normally compare India's status with China. Our 28 billion compares with 163 billion for China. China is at 163, we are at 28, which means there's a huge scope, long distance for us to cover when it comes to foreign direct investment. So this change hopefully would reinforce the country's position as an FDI destination. That's part one. Number two, looking at the major scope for insurance business, one hopes that there will be attention of foreign investors in the insurance sector. And with the combined result of this, we hope that penetration of insurance, which, like I mentioned, dropped down last year, the penetration ratio actually picks up, goes up. So that was about the proposal to increase FDI in insurance business. We now come to the next part, which is partial credit guarantee for insurance for infrastructure funding. Now, let me quickly give a background first. What exactly is partial credit guarantee? We're talking about infrastructure bonds or bonds issued by infrastructure entities. Infrastructure entity, I'm sure anyone can realize that when it comes to infrastructure operators or infrastructure entities, let's say think of someone who is operating a P2P project, somebody is invested in a road sector project, somebody is, let's say, invested in rail sector project. All of these are long-term investment. The investment takes pretty long time to pay back. Payback period could range anywhere between 5 years to 15 years. And therefore, these entities, they need to look for long-term funding. They need to look for funding partly during construction period, and partly they need funding after construction, after the so-called commercial operations begin. So need construction period funding is mostly extended by banks. Banks are the ones who give loans during construction. The construction might take 2 years, 3 years, 4 years, depending on the project. And thereafter, it takes a long number of years to recover the money invested in the infrastructure project. So that's where the capital market funding comes. When the infrastructure becomes on stream, when it starts generating revenues, at that stage, you need some investors to come in to allow an exit to the bankers. The bankers who put in money during construction, they need to what is called take out or exit the funding by refinancing of the project by capital market source, which is where the issuance of bonds by insurance by infrastructure entities comes in. As it stands, the biggest challenge for an infrastructure entity to issue bonds will be that the market does not expect, the market does not accept, the market does not lap up lower rated bonds in the country. In the India's bond market today, mostly people expect bond rating to be AAA or AA. Less than AA rated bonds are typically not picked up by investors. And most of these infrastructure entities, they don't have ratings equal to AA. Most of them might either be triple B, might even be less than triple B. So the ratings are not of a standard at which their bonds can be acceptable to investors in the bond market. That's a problem statement. We need huge funding in infrastructure sector. That's very clear because the country's economy can only grow with robust infrastructure. We have the issue of funding because the infrastructure entities would need capital market funding and their standalone rating will not be sufficient to attract capital market investors. That's exactly where we need someone who can support the rating of the bonds. Now, NABFID actually was incorporated with this objective. One of the major objectives of NABFID was to assist infrastructure entities to raise capital market funding. In what way can NABFID allow this problem to be solved? NABFID grants what is called, or NABFID may grant what is called partial credit enhancement. I've referred the word PCE there. Partial credit enhancement, which is in form of a guarantee. What's this guarantee? NABFID will take a part of the loss. If at all the bond in question goes under stress, under default, NABFID will contribute up to 20% of the money. That would mean if the insurance entity in question does not have sufficient money to pay back to service the bonds, NABFID will advance money to the extent of 20%. Up to 20% of the bond value, NABFID will contribute money. That's a kind of what is called liquidity support. With that, the bond issuer may continue to service the bonds so as to avoid a default. That's what is called partial credit guarantee. And that's one of the objectives of NABFID. So this is how a partial credit guarantee goes. Because of NABFID support, if you can see here, the issuer which issues its own bonds, the bonds may be lower rated. Let's say they might be rated triple B or higher before the guarantee. NABFID gives a partial credit support to the extent of 20%. With that, the enhanced rating might reach, say, A or AA, or it might even reach triple. Mostly it would get a rating upgrade of 2 to 3, what is called 3 or 4 notches. It might go up 3 or 4 notches. That's the kind of support that NABFID gives or NABFID is supposed to give. This is very common. This is currently being given by banks as well, though there are no real life examples of banks having given such a credit support. It's permitted by RBI, but mostly banks have not so far given such partial credit guarantee. This guarantee is what you call subordinated to the claims of other investors because investors will be paid first. NABFID will be paid only after the investors have been paid. And the support is revolving in nature, which means as and when the bond issuer needs the money again, if it has the money, it can pay back NABFID. Once it needs the money in future as well, it will be able to draw down on the facility once again. So it becomes a revolving liquidity facility given by NABFID to support the bond issue. That's what is partial credit guarantee. Now, currently, what's the issue? In the existing scheme of things, NABFID is existing for last 3 years. Is still not been able to successfully launch the partial credit guarantee scheme. What's the reason for that? The reasons are primarily two. Number one, somewhere in the NABFID law, NABFID regulatory framework, the fact that it can grant a partial credit support is somewhere not clear. There were guidelines of RBI issued long time back that talked about partial credit guarantee by banks. As of now, we assume that the same regulatory framework applies to NABFID as well, but that's as of now not very clear. So number one, lack of clarity. That's part one. Part two, however, a bigger problem is the capital required by NABFID for giving the guarantee. Now, this is a very little complicated thing, particularly by people who are from taxation stream. What's the meaning of capital requirement? Capital requirement for any financial entity, an entity needs regulatory capital. As per regulations, it needs capital. Capital is required by, as per the RBI guidelines for partial credit guarantee, capital is required for the extent to which the bond issuer is able to get a higher rating. Now, this is a little complicated, therefore, let me just try quickly to say that the capital required for an investor in bonds is connected with the rating of the bond. For example, the bond is triple B, the capital required might be 100%. If the bond reaches single A rating, the capital required might come down to 50%. If the bond reaches double A, it might come down to 30%. The bond reaches triple A, the capital required might come down to 20. So from triple B, which is 100% risk weighted, the capital required may come down to 20 if the bond reaches a triple A rating level. So assuming because of NABFID's guarantee, the risk weight as applicable to the bond comes down from 100% to 20%. As a result, there's a significant reduction in the capital required by the investor. Investor in the bonds will need lesser capital because the bond is now triple rated. So the question is, who will bring this capital now? That much capital, the extent to which investors would have got reduction in capital, that much capital has to be retained by NABFID. So NABFID will need as much capital as is the extent of capital relief or capital reduction in the hands of investors. That's the key requirement of capital as per the existing regulatory framework of RBI. Now that is still understanding. The bigger issue here is that though the bonds amortize over time, the bonds pay off over time, the bonds may partially pay down over time. However, this capital required by NABFID will remain constant right till the bonds are completely repaid. That is from the year of issuance till the year the bonds are completely repaid, NABFID will still keep that regulatory capital. That really becomes a very big bottleneck because every time NABFID goes and provides guarantee for the bonds, it has to shell out as much capital, and that capital will remain static even though the bonds come down. As the bonds come down, NABFID's income will also drop because income is typically based on outstanding value of bonds. Income drops down, but the capital still remains constant. That is the biggest bottleneck in the partial credit guarantee scheme as of now. The finance minister has proposed that the finance minister will introduce a regulatory framework for that. I'm not sure what that framework would be, but if this problem of regulatory capital is not resolved, no matter what the FM does in terms of permitting partial credit enhancement, the structure is unlikely to be really, really working because the problem of regulatory capital will still remain. Let me now move to the next part, which is dealing with amalgamations. This is actually a tax change, but this tax change has a corporate law impact, and therefore let me just talk about that. As I do understand, this topic might have been talked about by earlier speaker too, but let me just refer to the relevant part of the Companies Act versus Income Tax Act when it comes to the proposed change. What is the proposed change? I think everyone knows that because of Section 72A, if the merger takes place as per the conditions mentioned in Section 72A, then the losses, including unabsorbed depreciation, are deemed to be loss or depreciation of the year in which the merger takes effect. That is, if the merger takes effect, say from FY24, irrespective of the vintage of the loss, the loss gets another 8 years to lapse. Therefore, there is a sort of an evergreen. And the finance minister says that the finance minister doesn't want this evergreening to remain. It would put an end to the evergreening. That would mean 8 years vintage will still remain even though the merger might have taken place. So with the objective of stopping this evergreening, the finance minister has proposed a change to say that with effect from mergers which are effected from 1st April 2025. Remember, mergers which are effected on or after 1st April 2025 will be governed by the new provision whereby the 8 years vintage for the loss or unabsorbed depreciation will run from the year in which the loss or depreciation actually arose and not from the year in which the scheme of arrangement was sanctioned. Now, this proposal takes effect from 1st April 2025, which actually means what? As I'm sure everyone knows, there is a distinction between appointed date and effective date when it comes to schemes of restructuring. Appointed date actually means what? When we have a scheme of restructuring, we define the appointed date. Effective date, as per corporate laws, is the date on which the filing of the order of NCLT is done. That's the effective date as per corporate laws. But from income tax perspective, the appointed date is the effective date because that's very clear in the income tax law itself. If the date as per the scheme appointed for the merger to take place is say 1st April 2023, Even though the order is passed in 2025, if the appointed date is 1st April 2023, then the merger is effective from 1st April 2023. So, though the finance minister has made this change effective 1st April 2025, please to understand the change as and when enacted will be applicable only for those schemes where the appointed date as per the scheme, not effective date, the appointed date as per the scheme is on or after 1st April 2025, which means we still have some time if there are genuine cases where an appointed date of an appointed date before 1st April 2025 might be put. You can still probably, at least for a year or so, continue to do mergers and avail the benefit as per the existing law, not the changed law. Let me come to the next point, which is speeding up fast track mergers. Now, here the finance minister is actually saying that mergers need to be speeded up. As of now, there is a fast track merger scheme under Section 232. And the finance minister says that the requirements and procedures for speedy approval will be rationalized. What is currently the fast track merger proposal? Currently, it's permissible either when the merger is between two or more small companies, or between a holding company and its wholly owned subsidiaries, or two or more startup companies, or one or more startup with one or more small company. But it's startups, if we leave it aside, then as of now, it's mostly relevant for small companies. Small company actually is 4 crores of capital and 40 crores of turnover, so that's actually very small. Or between the holdco and the subsidiary. The subsidiary also has to be wholly owned subsidiary. These conditionalities are greatly curtailing the real life applicability of the fast track merger scheme. Actually, it's important to understand that ultimately, if the shareholders and creditors have given their okay, then the role for the NCLT in permitting a merger is very, very limited. And therefore, the entire process of mergers can actually be more and more creditor and shareholder driven rather than being driven by the NCLTs. And therefore, there's a significant scope for reducing the time gaps in approval of mergers. So I'm hoping that as the finance minister is talking about proposed change of law, the existing process of fast track merger will actually be expanded to include all holdings and subsidiary companies, not just wholly owned subsidiaries as the existing scheme is. Now, the next point I'm going to talk about is leasing from International Financial Services Center. And as this is something that people might generally be aware that as of now, when it comes to finance companies in IFSC, finance companies include an entity giving assets on lease as well, financial lease as well as operating lease. And as it stands, the IFSC finance company regulations include both aircraft lease as also ship lease. Now, what's the relevance of aircraft lease or ship lease from IFSC? Please try understanding from a holistic perspective. Why did India talk about IFSC and IFSC being a place for aircraft leases or ship leases? Existing practices of airlines across the world, including those in India, is to take the aircrafts on lease from overseas destinations. Most of the aircrafts that fly, you and all take flights into Indigo or Air India, whichever aircrafts. Most of them are acquired on, I think 90% plus of the aircrafts are acquired on lease basis. And most of these leases take place from Ireland. Ireland is the globally preferred jurisdiction for lease of aircraft. Years ago, there was a Ministry of Civil Aviation study group called Raftar Group. The Raftar, and I was a part of that group. The Raftar Group made recommendation that it's time for the situation to change. There is no reason why India should be relying to such an extent on aircraft lease from Ireland. Remember, in situation of political disturbance, this can actually become it's hugely problematic issue for the country. Assuming the country undergoes tension with some other popular leasing jurisdiction from where the aircraft might have been acquired on lease, because many of them are actually funded by investors from a particular country. If that country's investors, let's say India is into some kind of tussle with that country, suddenly we find the aircraft have been taken back. India has become completely immobile because the aircraft have been taken back by the respective lessors. This might be huge debacle for the country, so we need to reduce dependence. on aircrafts coming on lease from international jurisdictions. So why not think of the gift city as the place? That was the idea with which this mission Raftar was started. And over a period of time, this has taken shape because now, as on 31st March 2024, the data is that 20 aircrafts, this is still a very small number, but the country is having few thousand aircrafts operating, but only 20 have so far been leased out of IFSC. 49 aircraft engines have been leased, 56 ground support facilities have been leased, and in addition, four ship leases. One, two, three, four. Four ship leases have happened from IFSC till 31st March 2024. It's still, therefore, a developing idea, but the finance minister has tried its level best to give further relaxations to leasing from IFSC. So, this budget you find extension of the benefits of aircraft leasing to ship leasing from IFSC as well. In a sense, what this actually means is there are two proposed amendments, Section 10 by 4H, which is to capital gains by sale of shares of ship leasing entities, and Section 10 by 34B by way of dividends from ship leasing entities. So, all in all, if there's a ship leasing entity out of IFSC, the income of the leasing entity itself will be exempt in 10 out of 15 years. That's usual exemption, 10 out of 15 years income is exempt. For shareholders who are holding shares of such companies, they will not be liable to dividends, tax on dividends, and they will not be liable to tax on capital gains because both are exempted by virtue of Section 10 by 4H and Section 10 by 34B. In addition, I'm sure everyone realizes that there is no GST in IFSC and there is no basic customs duty on import of aircrafts into IFSC. I will not be talking at length on the treasury sentence, very, very narrow exemption, extremely narrow exemption. But let me straight jump to the next point, which is crypto assets. Now, here, the definition of virtual digital assets in section 2 by 47A is proposed to be amended by adding a crypto asset. See, India is a part of the global framework, crypto asset reporting framework. So we are a part of the entire global community. Therefore, this change is in line with global definition. Definition of crypto asset globally is the same that India is proposing. There's no change in that. We are exactly falling in line with the rest of the world. But the big part is that by virtue of this change, even efforts towards tokenization. Currently, the entire world is talking about tokenization of real world assets, RW. Tokenization of RW actually means what? That we're trying to tokenize real estate, we're trying to tokenize financial assets into tokens. And that's a trend which is growing all over the world. But because of the definition of crypto assets, any such tokenization will also be taken as a virtual digital asset with two consequences. Number one, there will be a flat 30% tax on any profits. And number two, there will be a 1% deduction of tax at source on any payment made by a resident to another resident by way of on account of any virtual digital asset. I'll take another few minutes to talk about this high level committee on regulatory reforms. I had mentioned earlier that it's become very, very important for the country to deregulate and to relax regulatory burden. Now, this has to translate into action. Mere committees and reforms, committee and committee recommendation do not help, but it has to actually translate into action. And therefore, the finance minister has proposed a high-level committee for regulatory reforms for all non-financial sector regulations. Remember, financial sector is kept out. That would mean SEBI, RBI, RDA will not be part of this. But other than SEBI, RBI, RDA, reforms in the certifications, licenses, permissions, regulations, this high-level committee will examine where all can we do relaxations. And that this is a very important noble task. Like I mentioned, the country's regulators have to learn to get out of the way of the business, allow business to proceed, barring such issues of ethics or good conduct of business. Businesses have to be allowed to stay and remain competitive by being as less regulated as possible. This is all that I had to share over the 40 minutes or so of my presentation. But should there be any interaction from any of the participants? Divyaji, over to you.
Thank you so much, sir, for this amazing session. It was really an informative one. Thank you so much. So there are a couple of questions. Can I take it?
Yes, please.
Yes. Just a second. First one is, how will startups ensure fair valuation in fast-tech mergers?
Okay, the rules of fair valuation exactly are the same as in case of any other company, which means exchange ratio has to be based on the fair value. Now, computation of fair value, this is not something which where section 11, rule 11 UA of the income tax rules applies. Therefore, here fair valuation is based on the valuer's own view on the intrinsic underlying value. Mostly in case of startups, the valuations are based on the discounted cash flows. Discounted cash flows incorporate assumptions on the growth rate of business. So if there's a startup merging with another startup or startup merging with a small company, the valuation of the startup would still be based on the discounted cash flows, which is estimated by the valuer looking at the growth potential of that. It's based on futuristic growth potential, not just based on past history. So the traditional net asset value approach does not apply in case of startups.
Okay. So one last question is, which additional type of companies might be included in the expanded scope of FTM?
So my expectation is that currently the structure is limited to 100% only on subsidiaries. But I'm guessing that now it might be extended to any subsidiary and not necessarily wholly owned subsidiary. That could mean if there's a holding and partly owned subsidiary as well, the benefit of fast track merger might be extended. In addition, the procedural simplification, because as of now, it still has to go for calling of shareholders meeting, creditors meeting, etc. So if there is a relaxation towards, for example, the meeting of creditors, that would also be helpful because mostly fast track mergers are stuck because of creditors meeting. Please, everyone understands that meeting of creditors here is not just one meeting of all creditors. There has to be meetings separately of each class of creditors. That would mean for every class, we call separate meetings and take the approval of every class. So that becomes a problem in many situations. Therefore, a procedural simplification may involve dispensation from meetings of class of creditors as well. Hopefully, that's where the finance minister will bring up changes.
Okay.
Divyaj.
Perfect, sir. Thank you so much, sir.
Great pleasure. Thanks a lot.
Thank you, sir.